Hello, Culture Matters podcast. Get ready for an exciting episode. Before I introduce you to our guest, here's a quote just for this episode. We all are learning, modifying, or destroying ideas all the time. Rapid destruction of your ideas when the time is right is one of the most valuable qualities you can acquire. You must force yourself to consider arguments on the other side. Charles T. Munger. Our guest today, another value investor, friend of the Culture Matters podcast. If I told you the story of how he met, you wouldn't believe me. They've been investing and analyzing and studying equities in the capital markets for some time now. They actually led, I believe, their college investment group, worked at the companies large and small, and learned the whole gamut of investing and growing success as a value investor. We'll talk about that in real estate and outside. Um, Co-founder of Revolution Capital or RevCap and principal at Keating Partners. Someone that I feel like I've known for years, but I'm grateful for our friendship. Gray Wilson, thanks for coming on the Culture Matters podcast. I'm so excited to dive into your background and what inspired you to invest and all the things that you and your partners are working on. Very exciting.
Yeah, I'm very excited to be here. And like you said, it feels like we've known each other a long time. So to get to do this with you feels pretty special.
Is that just like the value investor philosophy? I guess because you in college, you had a group, right? There you guys studied investing. Was it
That's
the
right.
similar spirit? And I asked that because being a shareholder of Berkshire and going to the meetings every year, it seems like there's something about value investors that's different.
Yeah, I think investing in general is a very personal thing. It has a lot to do with your temperament and how you view the world and your level of patience, right? I
Yeah.
think that a lot of different investing communities end up being personal and friend communities as well. You see that with crypto, even if I don't necessarily believe in it, you see a lot of similarities there that I think um, you're able to draw parallels with. And in college, there was a student investment group that was set up by some older alumni who basically wanted to begin preparing folks for investment banking primarily.
Huh.
So I was fortunate enough to be involved with that group, and like you said, went on to be the president for a period of time, and that was really a lot of my formal investing education in college.
What did that experience teach you about the process of research?
Yeah, that's a really good question. That was really the cornerstone of what we were doing. So we did every semester a pitch of a stock that we picked, and a lot of alumni would come back to campus, and it was a great networking event for us. So we took it extremely seriously. And as freshmen and sophomores, the juniors and seniors, when they're putting together their pitch, they're pitching for a potential job in front of folks who are currently in the industry. So they want you to perform well because it reflects well on them as the leadership of the group. And it really started to teach me about the tools that are available, both from a information and technology perspective, and also just some of the mental models that are out there to use. And that's I'd been a kind of a follower of value investing for a long time before that, but that was the first time that I was able to start applying that framework in a more practical perspective. And I continue to use a lot of those same frameworks and mental models today, even
Hmm.
though what I'm doing is very different than what we were looking at then.
Yeah, if you were to break down the differences from today, and
Yeah.
and I want to go into what you guys are doing and
Yeah.
what are some of the, I guess, gaps?
So the big difference is liquidity. So in real estate, you're trading a property twice in your holding period. You're buying it once, you're selling it, and in the interceding period, it's probably not being priced. Where a public equity or even a debt instrument is probably being priced daily. And that's a big difference to me, particularly psychologically. That's why a
Hmm.
lot of why I like real estate, and I sometimes have struggled with public equity investing, is it can be discouraging to have an idea that you really like and have worked hard on and watch the price decline every day. And if Buffett, Munger, Howard Marks, they all talk about the willingness to buy more when price is lower. The good news is on a real estate investment, there's no more building for me to buy. I I can buy a different building down the street, but I I don't have the ability to invest more capital into the building with a long runway, and it's not getting priced daily. So I don't have to sit there and worry about, oh, is the value of the building down 10%? If I'm not selling today, it doesn't matter, and I don't have to think about it, which frees up a lot of mental space to be thinking about, am I maximizing the operations of this building?
Mhm.
What am I doing to unlock value in other ways that's not sitting on my hands and hoping that the rest of the market recognizes what I see?
Wait, hold on. You just said something about operations and real estate. I thought TikTok was telling me if I had real estate, I could be a passive, but
Yeah.
no,
Yeah, I
hold
mean,
on. There's I had to interrupt
TikTok,
here.
yeah, no, TikTok will tell you that it's passive. I can tell you as you're standing there in a tenant's apartment at 8 o'clock at night, as it's torrentially raining outside and you're watching the water drip through their ceiling, it is not passive. It is passive until then, but the second that something goes wrong, it is an active endeavor for sure.
Yeah, I'd love to explore like that, so for
Hmm.
a moment here. Like because right, some of our many of our listeners may have dreamed of investing in whether equities or real estate, uh, and that's like their goal. They want to be involved in the real estate investments,
Hmm.
and they're being told to go in that direction, online, books, and so on. So, what
Hmm.
are some uh aspects of the real estate investing that may be overlooked? Like, for example, having to be there at 8 p.m. if there's that water breakage.
Right,
What are some
right.
things that might be overlooked? Some places of responsibility that our listeners that are doing that real estate, well, maybe it's a doctor that's listening to it, they just bought a 4 unit
Right.
apartment or something complex or something.
Right. So one of the frameworks that I like to think about for real estate operations in general is that regardless of what type of real estate you're investing in, what you're in is the storage business. You're in the space business. Some types of real estate, like industrial, you might literally be storing things. Retail, though, you might be storing somebody's business, right? Their livelihood. You are storing it for them. And in the case of apartments, you're storing people. Their entire life is going to happen inside of your apartment unit. And as I'm sure you know, and a lot of your listeners know, a lot happens in the course of a year that a tenant might live there, whether that's a death in the family or a promotion or losing their job. A lot of things can happen. And that human element of it, I think, is really overlooked. That being said, I do think that there are increasingly great ways for folks who might not be as operationally interested or inclined to get more passively involved with real estate, which has a whole other series of pitfalls that we could talk about.
Hmm.
But I think there are great passive options out there, but none of them are without headaches. So I think the operational aspect of it, if you're going to be investing directly in a given property, is key to understanding what your long-term ability to, unlock some investment performance is for you.
When you're looking for a value, what are some red flags?
That's a really, really good question. So part of what my partner Connor and I focus on, particularly in real estate, is the things that are completely out of your control. The primary one is the location. The location of your building is not going to change. You can put new paint on the walls, you can put in new appliances, you can go out and get all new tenants, but the location of that building is going to be enduring. So we really try to solve for the location first. And particularly over the past, call it 5 years, as the real estate cycle has gotten really hot, we've noticed a lot of people who are ignoring location in favor of maybe higher cash
Ah,
flow or uh, the price has gone up 10% in the last 2 years. It will go up another 10% in the next 2 years, things like that. We're more focused on how can we solve for that location question. So the biggest red flag is a bad neighborhood. We don't want to be in bad neighborhoods because we don't want to be betting on future change. We want to be in a
mm,
situation where we're happy with where we are today and we think it'll get better. But if it doesn't get better, we're going to be just fine too. And that
mm.
kind of goes back to some of those value frameworks that you've talked about with margin of safety. The When you hear Buffett talk about an idiot needs to be able to run the company because an idiot will run the company someday, that's kind of true of real estate locations too. Every pocket is going to have a down period of time. You want to make
Mm,
sure that you're in the best location when that downtime comes, because it will happen.
mm.
So we're always solving for that first.
Yeah, how would you explain the margin of safety or how you look at margin of safety with your thesis?
Yeah, so we spend a lot of time analyzing the numbers, putting them into Excel, running them forwards and backwards, making sure that we understand the market perfectly. But we're not going to be 100% correct. It just probabilistically, that's not right. And if you consider that, let's say there are 5 variables, 10 variables that are going to determine the success of a real estate investment, and you have a 90% chance of getting any single variable right, by the time you go out to 10 variables, you're almost certainly going to be wrong on one of them. So that margin of safety is what allows us to be wrong and still make money, still deliver return for our investors. And a lot of times, what that means to us is price. We want to recognize something about the property that allows us to pay more than somebody else, right? Because that's what it is at the end of the day. That's how you get a property, is paying more than the next person. Or we've gotten it in a way that allows us to pay less than it might trade for on the open market. So really the number one piece of due diligence that you can do on a real estate investment is how much am I paying for this? And that oftentimes is what drives the margin of safety.
Mm. What about because what advice do you have for our listeners around saying no or right versus saying no or creating guardrails around their
Yeah. Yeah.
investment decisions,
That's
not
such a
letting
great
them.
Yeah, that's such a great question. It's so important, and I'm guilty of it's not saying no enough all of the time. That when you're starting out in any kind of investing, I would literally write down what you're going to invest in before you start looking for it. So if you say, I want to be buying 4 unit apartment buildings in Fairmount, Philadelphia, at between this price and that price, write that down and hold yourself to it, at least for a
Hmm.
while. Maybe those deals don't exist out there. And it's worth having that conversation at some point, but you need to hold yourself to a level of discipline because like I said, I'm guilty of it at times as well. When you start overextending yourself just for the sake of doing a deal, you you risk missing something or overpaying or something to that effect. So you just need to be really disciplined. I can tell you that we say no all the time. I mean, look at, we'll screen 10 deals before we decide that one is even worth putting pen to paper. And then of the ones we put pen to paper on, it's probably another tenth of that that's worth an offer. And by the
Wow.
time we get an offer in, I can tell you that very few of those are accepted. So as you start to slice and slice and slice, you have to be comfortable with saying, you know what, this isn't for me. I might have spent the last week trying to figure out how to make this work. The reward for that week of work is that I'm a little bit smarter about the market. I'm a little bit smarter about the asset class. The reward is not that I've made an investment at the end of that week. Because if that's your goal, you're going to make a lot of silly investments just for the sake of doing so.
I want your insights on this. Just last night, it was this podcast. Shout out to Invest with the Best that I
Yeah.
randomly came across last night. Never heard of it.
Oh, it's
Loved it.
great.
It was amazing. There was a gentleman from Sixth
Yeah.
Street
I've
on
listened
it.
to the episode.
Okay, do you recall? Oh, this is Gray, you're the best. Do you recall the point where he's talking, I think Alan or something, he's talking about themes?
Yes.
Themes.
Yes.
Okay. Can we unpack that a little bit? It was so
Absolutely.
fascinating to me that it seemed like what I want to ask you is in the beginning, that fresh idea, that theme, maybe no one's seen it yet. There's an edge there. And then the
Yep.
longer that time elapses, there's so much competition, it's changing as it goes,
Right.
the opportunity. What's your take on that themes and on that theme concept? And is there overlap in how you guys approach things philosophically, even if you use different words or you
Yeah.
that episode?
Yeah, so fantastic episode. I would 100% recommend Invest Like the Best. Go back through and listen to some old episodes. Fantastic. That's a must
What was
listen
the
for
guy?
me.
Alan something from Sixth
His last
Street.
name starts with a W. Yep, Sixth Street.
Alan W.
And the themes. concept, I think, is really smart on his part. But he is operating in a system that's very distinct from the one that we're in. One, he's better capitalized than we are. He has a huge team. So he can go out and pursue 25 themes, and he can have an analyst or associate chasing down a given opportunity on a given theme. We don't have that luxury because it's just my partner and I who are working through those opportunities. But we do think thematically, as he outlines it, right? These things that are just going to be trends, typically over the next 5 years. We do think through those things, particularly as how that's going to allow us to source additional opportunities. So, for example, a great theme since COVID has been office to multifamily conversions. There's not
Mm,
enough new supply of apartments in many urban markets. There's way too much office space. And so the equalization of that balance has been a theme over the last few years. And to your point, I think there was a lot of edge there early on when that just was starting. It was very nascent. A lot of the best office conversion deals today have already been done. But I think there remain some of those great opportunities out there under that theme. So Connor and I, as we're in the market, we can say, hey, that's one theme that we can be looking for. Um, I think that that's a great framework. And I think a lot of people can recognize themes even if they don't know that that's what they're doing. If you just sit down and
mm,
think about what are some things that I think are true today about the world directionally. So AI, right? That whether you think it's going to be huge or, not so huge, it is hard to ignore that it's going to be bigger than it is today. That's a theme. So then how can you start investing, whether you're in public markets, private markets, debt, equity? How can you put that theme to work? So to your point, we do think about those themes. We just don't have the luxury of 25 of them. We try to
sure.
think about two or three at a given time.
You mentioned yourself, your partner. I'd love to understand the degree of focus that you believe is necessary to be successful. Focus, intensity, work ethic. What are your? Because I don't know which generation you're in. I'm a millennial. We have listeners from the oldest to the youngest that are coming up. What would you say? Your take is on work ethic and focus and how much that plays into um,
Yeah.
RevCap and Keating Partners and what you're doing for your investors.
Yeah. So I think the investing broadly in anything really, whether it's investing, athletics, it's all about repetition. And in investing, the way to get repetition is to just work on investing all the time. Look at deals all the time. Read about deals, themes, markets all the time. Because let's say you and I started from zero base knowledge today, and you decided I'm going to review a deal every week, and I just decided I'm going to review a deal every day. At the end of this year, you've gotten 52 repetitions. I've gotten 365. I'm so far ahead of you. I will crush you, right? It's inevitable. So we take that
Is
level
that
of
your
work
mission
ethic.
statement?
It could be. It could be because it
I'm
feels like
so
we look at a deal every
we
day.
are
So
so far against you. I'm sorry. That's just I'm getting excited about
yeah, I mean, we take very seriously the fact that we want to be the folks who are seeing every opportunity, have an opinion about every opportunity. I think that's something that is really worth stressing to people. Even if you might not, let's say you're out in the market and you're talking to a broker about a 4 unit apartment building that you really love, and they think it's worth 1.5 million, you think it's worth 1 million, and you truly believe in your heart of hearts it is worth $1 million. You put in your offer, the seller doesn't accept it. Come back in a month, call the broker and say, hey, did that deal sell? Oh, maybe it sold at 1.2. And you say, what was different about that buyer than me? Do they have a different investment return profile, right? What can I learn from the fact that my opinion is not the one that allowed for a transaction to happen? I think that's super important in public equities too, is just writing down an opinion, forming an opinion, and then seeing over time, was I right or wrong, even if it's not actionable to you at that point in time. And so my partner Connor and I, like I said, we look at it feels like thousands of opportunities some days because we want to make sure that we have an opinion so that we can find out if we're right or wrong and get incrementally better. And like I said, if we're going to look at 5 times more opportunities than you, we're going to be more likely to find one, and we're going to be more likely to find a good one and do it faster and better.
Hmm.
So we take that very seriously.
How, if at all, do you see real estate investment and equity, like private, public, complementing one another?
Yeah. So I think that's a really important question. I think for the average, let's go back to your doctor example.
Okay.
I think as much as I would like to sit here and evangelize about all of the great benefits of real estate, I think that ultimately for somebody, a high net worth individual, depending on their needs, real estate should ultimately represent a smaller portion of their portfolio than in public equities, just because of the liquidity component that we talked about. A doctor might have a rainy day that might force them to liquidate some public equities for that cash need. Real estate, the second you're looking to liquidate something quickly is when you're going to accept a lower price, you're going to incur transaction costs, and you give up some of your return that way. I think that they are extremely complementary, though, in terms of just seeing how the world works. I think that you can learn a lot about real estate from following public equities. Ultimately, at the end of the day, everything is downstream of real estate. So Starbucks, their returns, their earnings this quarter are going to be driven by where their stores are. That is going to be one of the key factors that determines how much revenue they're going to do. It's downstream of real estate. And the inverse is also true. The value of a building is going to go up if Starbucks is occupying it. So
Hmm.
the interplay of that is super important to understand. But in terms of portfolio construction, I do think that real estate for the average person who has a 9 to 5 job, or in the case of a doctor, maybe an 8 to 7 job, it should be a relatively small part of their portfolio because uh, it's intense intellectually and operationally. It's intense, and you don't have the ability to dip your toes in a lot of instances. Where in the public markets, you might say, okay, I'm going to buy $1,000 of Starbucks. It's very hard to buy $1,000 real estate investment, particularly in a way that you're fully protected.
So that's on the consumer side, the retail investor or
Mm-hmm.
uh, LP or so on.
Mm-hmm.
How about on the other side as the investor or
Mm-hmm.
investors for those that are even interviewing potential um, management teams to invest their capital, for them to think of it this way. What about, so from the investor standpoint, how what is the value? Do you have like a, and I'm asking this because you guys both have such strong backgrounds in equities, private, public, and real estate. There looks to be uh, a
Mm-hmm.
a thesis there. So do you think they complement one another and make the business better, the investment business better, to be looking at both and paying attention to both and engaged in both?
Yeah, absolutely. I think one of the things that is most critical as the general partner making those decisions and understanding the market is that you are ultimately reverting back to a risk-free rate. So a lot of real estate is leveraged. So I'm going to be borrowing money to go out and purchase an asset, which and my ability to borrow is going to impact my ability to pay the seller. And so I'm staring at the treasury market pretty much every day because that's my risk-free rate, typically the 5 year treasury, the 10-year treasury. And those risk-free rates are also what's driving public equities. And I think it's important to understand what the inputs are for you from a capital markets perspective, and then what the inputs are for public companies from a capital markets perspective. I think
Hmm.
you'll see the public markets will react certain ways to various movements in the bond market, and the real estate market will react in very different ways to the same movements. I think it's important to understand why. Um, and going back to reps and the hard work piece of it,
Yeah.
I think that it's good practice to be thinking about public equities because the information is right there and available. I can go and look at their earnings. I can go read interviews with their CEO. I can start to form those opinions. It's a lot harder to do that about the apartment building down the street. You can't just walk up to the building and figure out what every rent is in the building or what their expenses are or how it's managed. You might not even be able to figure out who owns it. But in the public markets, it's much easier to access some of that decision-making material that's important. And you can start to kind of flex that analytical muscle that way. And that's why I think a lot of folks really enjoy the transition from public equities into real estate or find it, um, you know, I don't want to say easy, but it's a fruitful transition, is that they've built that analytical muscle already, and then they get to apply that framework to a different challenge that's a little bit more opaque, a little bit harder to access. And like I said, it's also not priced every day, which is an important mechanism.
Is there is there an advantage to speak that language when, let's say, working the market for deals, especially in times of uncertainty?
Yeah, absolutely. I think that there, it's a really good question. There's definitely an advantage. I think that there is always an advantage to giving people the correct impression that you know what's going on. You're tracking the market. You actually are making decisions based off of informed thinking and decision making. So if you're going to a broker who might have a listing for a property and they have it listed for 5 million and you want to pay 4, your ability to say, look, this might be worth 5 million last year, but the bond market, the 10-year treasury is up 100 basis points since then, and my debt is much more expensive now, so I have to be at 4 million so that I can get X, Y, and Z cash on cash return. The broker isn't going to walk away and say, hey, this guy was lowballing me. They're going to walk away and say, hey, this guy spent a lot of time on this and reached a different conclusion than I did. I'll show them the next opportunity that I have because I know they're going to be thinking about that in a similar, thoughtful, informed way. So it builds a lot of credibility, just being able to speak that language comfortably.
Yeah, it makes me think of maybe another scenario with someone they don't know what they don't know, and maybe they just emotionally react, and they're just arguing or something. So
Exactly.
they can't come
Exactly.
to a head.
Exactly. That's exactly right. And you see that. You definitely see that.
Have you ever read or listened to Sam Zell's book? It's
Oh,
like,
absolutely.
oh
That's a must
man,
read.
that's I just thinking right now of like his early career when that one block he went and got a bunch of houses,
Yep.
and like he had to one by one meet with each owner because didn't he
Yep.
get, do you
Yeah,
remember
that's
that
exactly right. He
story?
was assembling student housing at the University of Michigan, and ultimately was able to build a big project there. And that was kind of his launching point.
And he learned about just human to human, how important
Yeah.
that. When
Yeah.
in the question I have piggyback in that, right? The Sam Zells of the world, these legends, right? I think he sold his company eventually to Blackstone or something for 40,
Mhm.
almost $40 billion. But they're in the top tier investors that you've met, entrepreneurs that you've met. Have you recognized like common denominators or of how they show up? Like similar to like a Zell. Like there's an interesting. I'm curious, like if there's
I love that
core
question.
values,
Yeah, I love that question. I think that's
regardless
a
of how
a
high they are
really
in
good
the
one.
hierarchy or whatever.
100%. I think that's a really, really good question. I think that when you meet when you meet people who are successful or you feel are going to be successful in their given asset class that they're investing in, they 100% have a personality that reflects the asset class. Typically in real estate, that is going to be somebody who's much more personable, a little bit more of a bulldog, because like I said, the information is not readily available. You're getting told no all the time, and you have to be a little bit more creative in the real estate industry than you might in some other types of investing. I can tell you that if you met a really successful fixed income mutual fund manager or a municipal bond fund manager, they're going to have a very different personality. And that personality is going to serve them and their success. It's just not going to be the same. I can't say that I've met anybody with the personality that I imagine Sam Zell having necessarily, but those characters exist in real estate. And that's part of what makes it so
Yeah.
fun is that you're in the market with guys like that who, exactly what you said, they might have started with a row home in South Philly and now they're building a tower in Center City. And all along the way, they've been doing exciting things, putting together interesting deals. And to be kind of in the same world as them is super special. And you run into those personalities all the time. And I'm confident that if you talk to a public markets investor, they might say something similar. But I think it's very unique to real estate that you have folks who can start with a very little piece of the pie and just over time compound and get bigger and bigger and bigger until they're doing something that's really pretty special and prolific.
There's a Munger quote I wanted to ask you about, something about the three L's that undermine wealth is liquor, ladies, and leverage.
Yep.
So when it comes to leverage, how is that how does that impact the return as you see
Yeah.
real estate, the risk versus reward? The many people listen to this that are entrepreneurs, they might be putting a percentage of their after tax into real estate and building portfolios as their companies grow and so on. And
Right.
they're being told different information, different takes on leverage, how to approach
Right.
leverage. What advice could you share around leverage and what's its purpose from a capital market standpoint down to Main Street?
Yeah.
You know?
So I think that's a great quote. And I think the Buffett retort to that quote was that the real one was the only one that mattered was leverage and that he just said liquor and ladies because it sounded better. Um, that
Yeah,
definitely is
that's
true. Leverage, we're seeing it a lot right now. Folks who took on too much leverage during the height of the cycle, they're really struggling because all leverage does, it's exactly what it sounds like. It amplifies the conditions that already exist.
hmm.
So your ability to lever up a deal is not going to change the unlevered returns of the property. So if I invest $100 and my property is going to pay me $1 every year, I'm getting that return. If I put $50 worth of leverage on it and now I'm paying the bank 50 cents, all you've done is just move the math around so you're paying the bank to reduce your equity portion. You're just increasing what already exists at the property. The property is still paying you $1. You're just giving a little bit of it to the bank every month. Um, so it's a really important way to maximize the return on your existing equity. I think that I would be shocked that there are very many true unlevered buyers of real estate out there in the market. There are probably some insurance funds who are out there unlevered, but the average private investor is going to be using leverage. And so you just need to be thoughtful about the likelihood that you're unable to pay that back at the end of the term, the end of the loan term. So there are a few ways to ensure that. One is to not use a lot of leverage. You'll see some folks who will go up to 80, 85% of the value of a property with debt, which if things go well, amplifies their return. But if things go poorly, they're underwater very quickly. That is an important one, managing your leverage from a raw dollar perspective. The other is duration. So if I put a loan on my property in 3 years, I might show up in 3 years and we're in a down cycle, which a lot of people are experiencing today, and they're underwater on their loan. If I put a 10-year loan on the property, the likelihood that that property is worth less today or excuse me, worth less in 10 years than it is today is very low. You'll see people where that's still, unfortunately for them, the case, particularly in office right now, where something structurally has changed. But if you're buying an apartment building in a good location, the odds that you're unable to get out of your loan in 10 years from now are incredibly low.
Mm.
And in real estate, really, ultimately, the primary way that you lose money is selling when you don't want to sell. So the loan can force you to sell at a time where you don't want to, just because you need to pay off the balance. You need to refinance and you're unable to get loan proceeds that cover it. So now you have to sell. You're going to take a hit on your equity. Whereas if you took a 10-year loan, you can say, all right, I can just sit here. Maybe I am underwater on my loan, but I don't have to sell. So I can ride the wave back up the curve. And that's really important, is structuring your debt in a way that you're never going to be forced to transact for any reason, because that's when you lose money.
How important, I have so many questions. How important or where does operational integrity come in the times where our valuation might be less?
Yeah. Yeah.
We don't have to sell. So how important, so we can hold on. How
Right.
important, or what would be your take on the operational integrity? The
Yeah, so you need
100.
to, I think a lot of times people get distracted when times are bad. Um, they might be sitting here thinking, man, my property is worth less today and I'm really unhappy about it. You need the discipline to continue maximizing the in-place cash flow of your property because there are two ways to really add value. One is sit there and hope that someday in the future, people will value real estate broadly in a different way than they do today, so they're willing to pay more. The other is to increase the amount of dollars that your property is generating. And there are two ways to increase it: push the rents or reduce the expenses. Different people take different approaches, but the right answer, I think, a lot of the time is both. You need to be doing what you can to push rent and reduce expenses at all times, not to the detriment of the property physically. You don't want to be saying, hey, I'm going to reduce the expense load down to zero, but I'm going to let the roof blow off in the next storm. And now all my tenants have leaks in their units and, it becomes a bigger problem. But you need to be thoughtful about how you're using the cash flow at the property. You need to be willing to maximize rent. And then for non-apartment asset classes, so we're in mixed use properties where there's a retail component to it. You need to have a firm grasp of what the retail market is and the risk of being unable to re-tenant that in that space in the future and what that might look like if you're not getting cash flow for an extended period of time.
Um, I want your feedback on this thought. I never quite had this thought before in this way.
Hmm.
Leverage, going back to that $100
Yeah.
and the $1 back,
Yep.
the debt isn't going to get us implicitly like more, it isn't increasing the $1. However, let's say we add 50 in debt,
Hmm.
leverage lets us scale personal responsibility. What I mean by that is now we have more equity to put in other. The leverage
Exactly.
comes from. I want you to unpack that a little because the leverage, the idea of leverage, if we get debt on it, the idea of leverage is we can do more with the equity, the limited equity that we have. So
Yep.
now so I wanted your thoughts on this because the three L's, right? It's if there's more to attend to be responsible for, that's a
Yep.
corporate responsibility. Maybe the other, metaphorically, the liquor and the ladies represents distraction.
Yes.
I'm curious of what your thoughts are on this. Is more like a cultural lens perspective. Never
Yeah.
quite thought of it like that, but like liquor's like
Yeah.
play, ladies is like if it's plural, like obviously that's more of a deep philosophical conversation, right? Based on how we live our lives and so on. But I'm curious of your thoughts on that, about this idea that leverage lets us scale. So, but with that comes personal responsibility. As someone that raises capital, invests capital, manages these properties, businesses, you're the perfect person to ask.
Yeah, so I think that is such a great framing. I've never thought about it. I've never thought about it like that before. I've certainly never thought about that quote like that before. I think going back to some of the things that we talked about earlier about saying no, discipline broadly is important, particularly if it's going to distract you from what you already have. So I think some folks they grow at the expense of existing operations, which is just so dangerous because a property might be humming for 3 months, 6 months, a year at a time, and then something hits the fan and you need to attend to it. If you in the interceding 12 months, you've gone out and bought three more properties that might also have something hitting the fan at the same time, and you're stretched too thin, you're going to be unable to do some of the things that we just talked about. You're going to be unable to attend to your building in the right way to make sure that it's being maximized from a dollar, dollar of return perspective via rent or expenses because you aren't as focused as you need to be. I think that is something that we have seen in the marketplace is folks who kind of grew too quickly without having some of the belt and suspenders systems that you really need. And that's why we feel extremely fortunate is we have a great accounting team, a great asset management team, a great HR department who not only have those systems in place for us and not only are able to support us, but also hold us to account. I think that's super important.
Mm,
You see masterminds get talked about on LinkedIn, and I think They've
Yeah.
gotten a bad rep in some respects, often deservedly. But one of the things that having that group around you allows you to do is hold you to account. Have people around you who you trust, respect, who say, "Hey, belt and suspender systems are not here. You need to focus on it." And sometimes that takes the form of our accounting department saying, "Hey, this invoice that you got where you spent $700 on this project, I think you could have gotten it done for 500.
Mm.
Why did you not get more bids? Who did you talk to about getting these bids? What was a process that led us to make maybe a suboptimal decision?" That's so important. That is so, so important. And I think a lot of people, at no fault of their own, and often, they go out and buy the duplex or the quad or whatever it is, and they just don't know what they don't know, like you said earlier, and they don't have anyone around them who can provide some of that belt and suspender stuff. And you will learn over time, but if you're learning lessons on one property, it's a lot easier than learning
Mm.
lessons on four, five, six properties at the same time, which exactly like you said, you might end up doing if you're using and abusing too much leverage. You might scale too quickly.
So now growth in that growth and stability, of course, there's a friction between growth and
Absolutely.
stability. So I would love to ask because of the diversity, uh, the complementarity of your partnership. What would you
Mhm.
say? How do you and your partner, so yourself and Connor, complement one another as it relates to management? And the reason I ask that is so many of our entrepreneurs, they have partners that they work with. Uh,
Yeah,
when just the other day, I had a Philly guy on the show. Him and his partner, they built a company. It was Brian McNally from 0 to 50 million in sales in 7 years, and GHI grabbed
remarkable.
them. Yeah, it's a pretty amazing. It was like a staffing healthcare
Yeah.
company, right? And they talked about the culture that they created. So, how would you say the both of you complement one another in your different roles to balance that growth and stability?
Yeah. So I'm going to steal from Howard Marks when he talks about the founding of Oak Tree. He talks all the time about Bruce Karsh and how they had shared values but complementary skill sets. That's how Connor and I are. And I think that that's so, so important is that we know each other's values. We understand each other's values. We have our own culture between the two of us. The things that we take seriously, our goals. I could spend the next hour talking about what some of those things are, but we value that discipline. We value that hard work, but we also value integrity, honesty, our families, time with our families, doing things that we find to be fun, doing those fun things together. I think those are some of our values that I at least hold very dearly. And I'm sure if you talk to Connor, he would say something similar. And that allows us to be really complementary with our skill sets. We're both extremely growth oriented, first and foremost. I don't know that we would be in together and in the place that we are today if we both weren't focused on growing.
Mm.
I think where we're extremely complementary is we trust each other enough to take the step to the edge. And we also trust each other enough to say, if I'm right at that edge and Connor's saying, whoa, 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 hey, we got to pull back here. I trust him enough to know that he might be seeing something I'm not seeing. And I can say, I can slow down in that way. The other piece of it is that we consciously, going back to the themes or some of the mental models or heuristics, there are a lot of different things that people say about them. We know when we might be pushing for the sake of pushing because we've already talked about some of the things that we're going to look for. And like I said, it's much easier to go to Connor and say, "Hey, we talked about what we were going to be doing. What you're proposing, I don't think is necessarily in line with what you're proposing," rather than just saying, "Hey, I don't want to do that." Right? Because he knows that
Yep.
if I'm saying to him, "Hey, I think this is outside of what we should be doing," he trusts me enough to say, "Oh, all right, let me take a step back." And at the very least hear him out. Right? Maybe he's nailed it or I've nailed it, but we don't have the ego to be like, "Oh, we need to not do this or we need to do this thing."
Mm.
So I think that's super important is a level of trust, honesty with your partner. Because growing feels good. Growing feels really good, but it feels terrible to screw something up because you've stretched yourself too thin.
For our listeners, what are you looking for as an organization, Revolution Capital, which I do want to end on why the name and the
Yeah,
vision, but what are you looking for in investors? Because you have a long vision ahead of you, the
right.
types of values that you look for in and yeah, I should say this is not investing advice and you're not
I appreciate that.
asking people for capital or something. I'm curious what you look for when it comes to investors because there's only uh and the people listening may not know this, but like what's that one mathematician that we just lost? Not Ed Thorpe, it was James Simon,
Yes.
okay?
Yes.
If I understand the medallion fund, like you weren't, people couldn't just get into that thing. I mean,
Right.
it
Right.
was 66% return every year forever. But so like what core values or thought processes or questions do you look, strike you as exciting that listeners that are looking to partner up with the right managers over their career,
Yeah.
whatever they do, you could give
Yeah.
feedback to.
Yeah. I think a lot of those values are going to be the same one that we just talked about. When the things that I really value in my partnership with Connor and ultimately our relationship as friends, even honesty that we take incredibly seriously, and the willingness to be honest when it's uncomfortable. I really value our ability to be honest with our investors when things are difficult, because they are difficult. They can't, not everything's sunshine and rainbows. There are not the guaranteed returns, like you said, he might guaranteed passive returns that you see on TikTok. And I also want an investor base who's able to be honest with us, hold us to account, say, hey, this doesn't seem like an opportunity that you all should be doing. Seems like you've stretched yourselves in these ways. That's really important. We really value dialogue because we get smarter when we have those conversations. A lot of our partners, the value that they're adding, in addition to the fact that there might be a partner with us on a deal, they're intellectual partners to us. We might show them the next deal that we're thinking about, and they
Yep.
provide phenomenal feedback. And as I'm saying this, I don't want to shout the people out, but I'm thinking of those people in my head. We have those people in our lives, and I'd love to have more of them. The second one that is duration. Connor and I are young guys. We want to be able to do this with people over a long period of time because that's where the magic starts to happen. That's where the magic happens in all real estate, or excuse me, in all investing, but particularly in real estate. So we are not looking for folks who are looking for a get rich quick opportunity. We want to be in it for the long game with folks who are interesting, are able to provide great input on opportunities. And sometimes that opportunity, that input is not the analytical input. It might be that, hey, maybe we presented something incorrectly, and this doctor who's learning more about real estate doesn't understand it. That's our mistake. We should be presenting the information in a way that's digestible for the intended audience. That's fantastic feedback as well. It doesn't have to be, hey, I think you underwrote the rent wrong in year 3. It
Mm.
can, there are lots of great ways to provide that partnership. So I think those are the two biggest things that come to mind is the opportunity to dialogue and the opportunity to continue a relationship for a long, long time.
Mm. Um, I don't remember the hard numbers, but I know that since if we're using Berkshire, 1965 till 2024, the S&P was about 39,000% return, but
Mhm.
comparatively, Berkshire was 5 million and a half,
Yeah.
5.5 million.
Yeah.
Shows the power of that trusted partnership. So in that spirit, Gray, thanks for coming on the Culture Matters podcast. I can't wait for next time already. It's exciting, and I would urge our listeners to reach out to you guys. On that end note, can you just give us the best way if we have listeners that want to get to know you more, maybe set up a call with you or meet you
Yeah.
in Philadelphia, share your information, and just tell them why did you name the company Revolution Capital?
Yeah, absolutely. So the reason we named it Revolution Capital is for a couple reasons. One, we're in Philadelphia. The revolution's all around us. We see it with the 76ers. I walked by Independence Hall today. It's a good way to shout out our hometown that we love so much. And the other piece of it is that we want to be constantly evolving. I think revolution really suggests movement. We want to be constantly moving and active. So that's how we came to the revolution piece of it. The two best places to reach me, number one on LinkedIn, Gray Wilson. I'm easy to find. The second one, my email, gwilson@revcapgrp.com. I'm always in my email. I will see you there. I will respond. I try to pride myself on prompt response to email. So
Mhm.
please feel free to reach me there. And I'd be happy to hear from anybody. And I also love reviewing deals. If you have a deal that you're thinking about investing in with somebody else for yourself, I'd love to look at it and provide feedback because that is how we get smarter and better, which is so important to us.
Gray, thank you so much. If you're listening to this, go email Gray, share this with a friend who has interest in investing and can maybe over lunch or coffee they keep bringing up how easy it's going to be and they need the
Yeah.
right information in their mind so they could do it in the best possible way. Great mentors. And please leave us a review in the Culture Matters podcast and we will see you next time. Thanks, Gray.
Thank you.